In this exercise, we will calculate net income and total stockholders' equity. In Requirement 1, we calculate the net income. Net income is the difference between revenues and expenses. Aqua Products has revenues of $20,000 and expenses of $12,000. Net income is $8,000, which is the difference between the two amounts. In Requirement 2, we calculate total stockholders' equity using the accounting equation. Rearranging this equation, we can calculate stockholders' equity as the difference between assets and liabilities. Aqua Products has assets of $90,000 and liabilities of $40,000. Total stockholders' equity, therefore, is equal to $50,000. In this exercise, we will calculate net loss and total stockholders' equity. In Requirement 1, we calculate the net loss. Net income or net loss is the difference between revenues and expenses. Zeta Network has revenues of $17,000 and expenses of $23,000. Net loss is $6,000, which is the difference between the two amounts. In Requirement 2, we calculate total stockholders' equity using the basic accounting equation. Rearranging this equation, we calculate stockholders' equity as the difference between assets and liabilities. Zeta Network has assets of $45,000 and liabilities of $34,000. Total stockholders' equity, therefore, is equal to $11,000. In this exercise, we will prepare an income statement using the appropriate accounts. To prepare an income statement, we need to consider revenues and expenses. From the account balances provided, we can see that Vital Accounting Services earned revenues of $12,000 during the month. The next item would be expenses. From the list of accounts, we see that the company incurred salaries expense of $4,000 and rent expense of $2,500. Therefore, total expenses equal $6,500. Net income is the difference between revenues and expenses. In this example, the difference between revenues, which is $12,000, and total expenses, which is $6,500, equals net income of $5,500. In this exercise, we will prepare the statement of stockholders' equity. Let us start by entering the beginning balances. The beginning balances are $25,000 for common stock and $12,000 for retained earnings. Total stockholders' equity at the beginning of the year is the sum of these two values, which is $37,000. During the year, the company issues additional common stock for $15,000. This increases total stockholders' equity by the same amount. Now, let us add the net income of $10,000. This increases retained earnings and leads to an increase in total stockholders' equity for the same amount. The company pays dividends of $3,000. Dividends reduce the balance of retained earnings as well as total stockholders' equity by the same amount. Now, let us calculate the ending balances by summing the values in each column. Common stock has an ending balance of $40,000. Retained earnings has an ending balance of $19,000. Total stockholders' equity at the end of the year is $59,000. We can also check this final value of $59,000 by adding the ending balances of common stock and retained earnings. In this exercise, we will prepare a balance sheet. To solve this problem, we will identify the account types and categorize them into the accounts that appear in the balance sheet: assets, liabilities, and stockholders' equity. For dynamic consultants, assets include cash, land, and equipment, and liabilities include accounts payable and notes payable. Common stock and retained earnings are part of stockholders' equity. Note that the last two accounts, service revenue and salaries expense, are reported in the income statement. They do not appear in the balance sheet. We add the balances of cash, land, and equipment to get total assets of $60,000. We add the balances of accounts payable and notes payable to get total liabilities of $23,000. We then add the balances of common stock and retained earnings to arrive at total stockholders' equity. In this case, the retained earnings balance is unknown and can be calculated using the accounting equation. The accounting equation is assets equal liabilities plus stockholders' equity. We know that total assets of $60,000 equal total liabilities of $23,000 plus total stockholders' equity. The total stockholders' equity is the sum of common stock of $20,000 and retained earnings, which is unknown. Thus, by rearranging the accounting equation and moving all values except retained earnings to the left of the accounting equation, we calculate the retained earnings as $17,000. Substituting this value into the stockholders' equity section of the balance sheet, we add common stock and retained earnings and find that total stockholders' equity is $37,000. We can now check if the accounting equation is in balance, which is a requirement for a valid balance sheet. Total assets equal $60,000, and total liabilities and total stockholders' equity add up to $60,000. Therefore, the accounting equation is in balance, and the balance sheet is complete. In this exercise, we will calculate the ending balance of cash and prepare a statement of cash flows. In Requirement 1, we calculate the ending balance of cash. First, we enter the beginning balance of cash, which is $12,000. To this amount, we need to add all cash inflows and subtract all cash outflows. Note that cash outflows are amounts placed in parentheses. By adding cash inflows to the beginning balance and subtracting cash outflows from it, we calculate that the ending balance of cash is $70,000. This completes the first requirement. In Requirement 2, we prepare the statement of cash flows for the same accounting period. Remember that a statement of cash flows has three categories that cover three fundamental business activities. Operating cash flows include cash receipts and cash payments for transactions involving revenues and expenses. Investing cash flows generally include cash transactions for the purchase and sale of investments and productive long-term assets. Financing cash flows include cash transactions with lenders and stockholders. Let us look at each transaction and classify them into the three categories of business activities. $33,000 of cash received for sale of services is an operating activity involving revenues and is an inflow of cash. The next transaction involves a cash outflow of $5,000 for advertising. Advertising is an operating expense and therefore will be classified as an operating activity. In the next transaction, the company receives $10,000 cash by selling an unused warehouse. Remember that investing activities generally include cash transactions for the purchase and sale of investments and productive long-term assets. Therefore, we categorize this inflow of cash as an investing activity. Next, the company pays $15,000 to its merchandise suppliers. This is an expense relating to the normal operations of a company and is classified as a cash outflow in the operating activities section. In the next transaction, a sale of products to customers is a revenue activity. Therefore, it will be classified as a $60,000 cash inflow in the operating activities section. During the year, the company purchases factory equipment for $60,000. We classify this purchase of productive long-term assets as an investing activity. Next, the company borrows $75,000 from the bank. We classify this cash transaction with the bank as a financing activity. In the next transaction, the company pays $10,000 as dividends to stockholders. This is a cash transaction with the stockholders, and we classify this as a financing activity. In the final transaction, the company pays $30,000 as salaries to workers. Cash payments for transactions involving operating expenses are classified as operating activities. Now, let us calculate the net cash flows from each of these activities. To do this, we will add the cash inflows and subtract the cash outflows for each activity. Operating activities has net cash inflows of $43,000. Investing activities has net cash outflows of $50,000. And net cash inflows from financing activities equal $65,000. We total these three values to get the net increase or decrease in cash. We will add net cash flows from operating activities of $43,000, subtract net cash outflows from investing activities of $50,000, and add net cash flows from financing activities of $65,000 to get the net increase in cash of $58,000. By adding the beginning balance of $12,000 to the increase of $58,000 in cash, we calculate the end-of-year cash balance to be $70,000. Note that we obtain the same answer in requirement 1. The statement of cash flows is now complete. In this exercise, we will compute missing amounts from financial statements. In situation 1, we have to calculate net income. Net income is the difference between revenues and expenses. In this case, it is the difference between $45,000 and $33,000, which is $12,000. In situation 2, we will calculate the amount of dividends. Note that both net income and issuance of common stock increase stockholders' equity, while dividends reduce it. Now, let us enter the known values. By rearranging the equation, we find that dividends for the period were $7,000. In the third situation, we calculate liabilities using the basic accounting equation. Assets equal liabilities plus stockholders' equity. Let us rearrange this equation to directly obtain liabilities. Substituting the values, we determine the liabilities to be $23,000. In the last situation, we have to calculate the net financing cash flows. Total change in cash for a period is calculated by adding cash flows from operating activities, investing activities, and financing activities. Here, we have all the values required to calculate the missing value. By rearranging the equation, we calculate the net financing cash flows as $9,000. In this exercise, we are required to calculate the balance of retained earnings at the end of each year for Cooper Corporation. From the information provided, let us start with the calculation of retained earnings for the first year. Retained earnings is an internal source of stockholders' equity. It represents the cumulative amount of net income earned over the life of the company that has been kept in the business, rather than distributed to stockholders as dividends. The balance of retained earnings is calculated by adding the beginning balance of retained earnings and net income, and then deducting dividends. Note that in this case, the beginning retained earnings for year 1 is $0, net income is $1,800, and dividends amounted to $600. By solving the equation, we determine the ending retained earnings for the first year to be $1,200. Next, we will calculate ending retained earnings for year 2. Note that the ending retained earnings of year 1 will be the beginning retained earnings for year 2. So, by adding $1,200 and $2,300, and then deducting $600, we arrive at the ending retained earnings for year 2 of $2,900. For year 3, the beginning retained earnings will be $2,900. For year 3, net income is $3,400, and dividends are $1,500. By solving the equation, we calculate the ending retained earnings for year 3 to be $4,800. Similarly, we will calculate for year 4 and year 5. In this exercise, we will calculate amounts related to the balance of retained earnings. The key to solving this problem is to understand that change in retained earnings for a period is equal to the difference between net income and dividends for the period. In the first scenario, we have the amounts for change in retained earnings and dividends. The unknown value is net income, which can be found by rearranging the equation. By substituting the values, we find that net income equals $4.2 billion. For the next company, we have amounts for both increase in retained earnings and net income. Dividends can be calculated by rearranging the equation. By substituting the values, we determine dividends to be $1.5 billion. The next situation is similar, where we have to calculate the amount of dividends. We are given the change in retained earnings and net income. By substituting the amounts, we find that Spice did not pay any dividends during the year. In the case of Polestar, we have to calculate the amount of ending retained earnings, given the beginning balance, net income, and dividends. By adding net income and subtracting dividends from the beginning balance, we calculate the ending retained earnings balance. Since there was a net loss, we will subtract it. By substituting the values, we calculate the ending retained earnings balance to be minus $3 billion. In the final scenario, we have to calculate the beginning balance of retained earnings, given the ending balance, net income, and dividends. By subtracting net income and adding dividends to the ending balance, we calculate the beginning retained earnings balance. By substituting the values, we can see that the beginning retained earnings balance is $1.8 billion. In this exercise, we use the accounting equation to calculate amounts related to the balance sheet. The key to solving this problem is to understand the basic accounting equation: assets equal liabilities plus stockholders' equity. Fisher Incorporated reports total assets of $20 billion and total liabilities of $14 billion. By substituting the values for assets and liabilities in the accounting equation and rearranging the equation, we calculate total stockholders' equity as $6 billion. Travel Guide reports total liabilities of $200 million and stockholders' equity of $50 million. By substituting these values, we find that total assets equal $250 million. Office Supply reports total assets of $4 billion and total stockholders' equity of $0.5 billion. By substituting these values and rearranging the equation, we determine the total liabilities to be $3.5 billion. Windsor reports an increase in assets of $3 billion and an increase in liabilities of $1 billion. To find the change in stockholders' equity, let us use the basic accounting equation. We substitute the values and rearrange the equation to calculate the increase in stockholders' equity as $2 billion. Crest reports a decrease in liabilities of $2 billion and an increase in stockholders' equity of $1 billion. By substituting the values, we find that assets decreased by $1 billion. In this exercise, we will analyze cash flows for each of the following transactions. To solve this exercise, remember that the total change in cash for a period is equal to the sum of cash flows from operating, investing, and financing activities during the period. Venus Dredging reports operating cash flows of $5 billion, investing cash flows of $1 billion, and financing cash flows of minus $6 billion. By substituting these values into the equation, we calculate the amount of the change in total cash to be $0. In this example, financing cash flows completely offset cash flows from operating and investing activities. Complete Foods reports operating cash flows of $0.5 billion, investing cash flows of $0.75 billion, and a change in total cash of $1 billion. By substituting these values into the equation, we find that cash flows from financing activities equal minus $0.25 billion. Money Mint reports operating cash flows of $4.5 billion, investing cash flows of minus $1 billion, and financing cash flows of minus $3 billion. We know that beginning cash balance is $0.5 billion. To this, we add cash flows from operating, investing, and financing activities to calculate the ending cash balance. By adding the values in the equation, we find that the ending balance of cash is $1 billion. Petro Global reports operating cash flows of $4 billion, financing cash flows of $3.1 billion, and a change in total cash of $6.5 billion. By substituting the values into the equation, we calculate the cash flows from investing activities to be minus $0.6 billion. In the final situation, we know that Network Partners reports investing cash flows of minus $1 billion, financing cash flows of $0.5 billion, and a change in total cash of $3 billion. By substituting the values and rearranging them, we calculate the cash flows from operating activities to be $3.5 billion.